All right, let's jump right in. If you deal with any significant cash transactions in India, you're going to want to pay close attention to this. See, the Income Tax Act is getting a major overhaul for 2025, and it's set to really shake up the rules for how we all handle cash.
And look, this isn't just some minor tweak we're talking about. These are pretty fundamental rules, and they come with some serious penalties if you ignore them. So, what we're going to do is break down exactly what's new so you can stay on the right side of the law.
Now here's the interesting part. The government hasn't actually thrown out the old rules. Nope. What they've done is reorganize them. So the core ideas are still there, but the section numbers that we've all memorized, they've changed. And that's exactly why it's so easy to get caught off guard.
So here it is in a nutshell. Those old sections you might know, like 269SS, 269ST, and 269T, they've got new homes. They're now known as Clause 185, Clause 186, and Clause 188. Getting this new numbering down is really the first step.
Okay, here's the first magic number you need to lock into your brain. 20,000 rupees. Just keep that figure right at the front of your mind because it's the foundation for the very first major rule we're about to tackle.
So, where does that 20,000 rupee limit come into play? Well, it's the absolute heart of the new Clause 185. And this clause is all about the rules for when you accept money in cash, specifically for things like loans and deposits.
And the rule itself, it's pretty straightforward. If you're on the receiving end of a loan, a deposit, or some other specific type of advance, you simply cannot, I repeat, cannot, take 20,000 rupees or more in hard cash. The law is absolutely crystal clear on this.
So, if cash is out, then what's in? Well, the government wants a trail, right? And that means you have to use official channels. We're talking checks, bank drafts, and, of course, all the digital payment modes we use every day.
Honestly, it doesn't get much simpler than this. At the end of the day, when it comes to loans and deposits, the big message from the tax department is loud and clear. Just don't take large sums of money in cash. Period.
Okay, ready for the next key number? This one's a lot bigger, 10 times bigger actually, but the rules that go with it are a little more layered. 2 lakh rupees, or 200,000. This brings us right to our second major rule.
Now, this second rule, which falls under the new Clause 186, it shifts the focus a bit. We're moving away from just loans and into a much wider category, just receiving large amounts of cash for pretty much any reason. And this is where a lot of people can get into trouble without even realizing it.
So the starting point is a flat-out ban on receiving 2 lakh rupees or more in cash. But wait, it's not that simple. The rule actually has 3 specific conditions that you absolutely have to know about.
Condition number 1. You can't get that much cash from a single person in a single day. So, let's say someone owes you money for a few different things. If the total cash they give you hits that 2 lakh rupee mark within 24 hours, you've crossed the line.
Second condition, the limit applies to a single transaction. Now, this is a big one because it closes a really common loophole. You can't, for example, sell something for 5 lakhs and then try to be clever by taking 3 smaller cash payments. If it's all for one sale, it's the total cash that counts.
And the third one, and this one is so important, is that it covers all transactions that are tied to a single event or occasion. So picture a wedding caterer. They can't just take multiple cash payments from different family members if it all adds up to 2 lakh or more, because it's all for that one wedding. The event itself is the link.
So, what's the big takeaway for this rule? Again, it's super simple and direct. Just stay away from large cash receipts. Don't even go there. It's really the only surefire way to stay compliant.
All right, we've gone over the new numbers and the new rules, but now let's talk about the stakes. Why does this all matter so much? Because even though the section numbers have been shuffled around, the government's tough stance on undocumented money hasn't softened one bit. Compliance here is not a suggestion.
This says it all, doesn't it? There is no leniency, there's no wiggle room. This renumbering isn't a relaxation of the policy, it's just a reorganization. The framework is designed to be tough, and it's staying that way.
And you know, if the rules are strict, you better believe the consequences for breaking them are severe. We're talking about a penalty that can be up to 100% of the amount. Think about that. If you illegally accept 2 lakh rupees in cash, you could be hit with a penalty of 2 lakh rupees. That's a huge risk that's just not worth taking.
So, as we wrap this up, it really leaves us with a bigger question to chew on.
You know, with UPI and digital payments becoming the default for everything, and with tax laws like these getting tighter and tighter, are we actually watching the final chapter for large-scale cash deals in India? It's definitely something to think about.